Go ahead and call the meeting to order, the investment committee open session meeting to order. And can I have you call roll? Pam?
Teresa Taylor.
Here,
Rob Fechner.
working on it.
Henry Jones.
Here.
Lisa Middleton. David Miller.
I'm here.
Stacey Oliveris.
Here.
Jason Perez.
Here.
Ramon Rubalcava.
Here.
Betty Yee.
Here.
Rob Fechner. Still waiting.
Not yet. Okay. So what I need to do right now is approval of the April 2020 Investment Committee timed agenda. Can I get a motion?
So moved.
Moved by Mr. Miller. Can I get a second? Second by Mr. Perez. All those in favor, and now we have to take a vote.
Again, waiting for Rob.
Yes.
Teresa Taylor.
Yes.
Henry Jones.
Yes.
Lisa Middleton.
Yes.
David Miller.
Aye.
Stacey Oliveris.
Yes.
Jason Perez.
Yes.
Ramon Rubalcava.
Yes.
Betty Yee.
Yes, aye.
Thank you.
Okay, and it looks like we're still waiting on Rob. So our next item is executive report from our Chief Investment Officer, Ben Yang.
Thank you, Madam Chair. Good afternoon, members of the Investment Committee. I would like to spend the next 20 to 25 minutes to give you an update on how we are managing the portfolio through the current COVID-19 crisis, and particularly draw upon the work, benefiting from the work we have done in the past, preparing such a drawdown. So I'm very pleased to be joining you this afternoon. So although we're not in meeting in person, I'm very grateful to our Calpers team members who are making it possible for us to use technology to hold meetings remotely. And I hope you and your loved ones stay safe and well during these challenging times. I won't touch on recent events in the financial market, since shortly you will be hearing from our chief economist to 100% remote operations in just a week. This is truly an extraordinary achievement, which reflects their dedication and their great skill in serving our members. I also would like to express my heartfelt gratitude to our investment team. We are working alone from home and pulling together as one team. I feel a great sense of pride and confidence in the hard work which is underway. We will navigate this crisis together. We do not know what exactly lies ahead, but our portfolio is prepared to weather the storm. After the 2008 global financial crisis, we took a hard look at our portfolio management processes and our governance structure. We did not know when and how the next crisis would unfold, but we knew it would come eventually. Because of this, over the last several years, we have developed a comprehensive plan to prepare for a market drawdown like this one. And we are currently acting on that plan in managing our portfolio through the COVID-19 crisis. We are confident in saying that we are much better positioned now than we were during the 2008 global financial crisis. The COVID-19 crisis has generated some extreme market dislocations, which in turn present opportunity. We are happy to report to you that our plan, by and large, is working as expected. Some of the investment strategy seeds we planted last year have started germinating already. In addition to managing the portfolio through the COVID-19 crisis, we are also preparing for the future. we are continually developing and dynamically adjusting our future plan as the current crisis unfolds. So to ensure that we are positioned not only to survive this crisis, but to thrive afterwards. So given this challenging environment and the related volatility in the financial markets, I thought it was important that I briefly revisit some of our priorities. The 3 portfolio priorities that the board approved are: number 1, mitigate market drawdowns. Number 2 is to achieve 7% return in the long run. And number 3 is to stabilize contribution rates. To support these priorities, the board approved allocation to risk segments in December 2017 to be effective on June 30, 2018. And these risk segments are scalable, effective, and inexpensive way of offering tail risk protections to our portfolio. In addition, several changes were implemented shortly after I arrived. I'm proud to say that we are much better positioned to survive and then thrive. These changes include the migration to total fund portfolio management, including a centralized governance structure. It also includes an enhanced balance sheet liquidity management framework, which includes the visibility into both the sources as well as uses of liquidity at different future time horizons. During times of a crisis, our enhanced balance sheet liquidity management framework has allowed us to generate liquidity on demand, while the centralized governance structure allows us to allocate balance sheet liquidity in the most efficient way, maximizing the benefits to the total fund. Those recent enhancements were put to the test during the recent market turmoil, and they have been working as anticipated. The results of our enhanced ability to generate and allocate liquidity during time of crisis is critical for us to ensure paying the benefits promised to our members. With these improvements and the fact that our drawdown mitigation plan is standing the test of the current market turmoil, it is time for us to pivot to the second priority, which is to achieve the 7% return in the long run, since our discussion with you on the topic this morning. So now let me turn to the total fund. First, I'm glad to report that our asset allocation is behaving in alignment with expectations. Our risk mitigation plans have provided meaningful diversification and mitigated the drawdown impact on the portfolio during this time of market volatility. Second, as I just mentioned, that our liquidity profile is robust. Our centralized cash management has been key to our ability to control and reduce risk in our cash portfolio. The team has been diligent and proactive in ensuring adequate level of the liquidity for the total fund. And third, we are benefiting from our total fund governance structure and the new data tools to put us in a better position to respond to this volatility. So again, I cannot emphasize enough how the team's great work in all these areas over the last couple of years has put us in a strong position to face the challenges ahead. Now, I would like to take a moment to speak to a topic that has received some attention in the media. Basically, our portfolio management decision related to explicit options-based tail risk hedging strategies. I want to address this in order to put the facts on the record. Although this decision in and of itself does not rise to the level of materiality to our total fund, it does give us an opportunity to review a broader topic, our efforts taken in the recent past to prepare ourselves for market drawdowns such as this, and how that plan is holding up during this crisis. I would like to note that tail risk hedging, left tail risk hedging, market drawdown mitigations, and insurance are closely related topics that have been used interchangeably. These are all strategies that an investor can use as part of their risk management toolkit. The question for any investor is, what are the most efficient and cost-effective ways to protect the portfolio? For a large and complex portfolio such as ours, we often have a top-down portfolio construction themes, and then we build a portfolio of strategies to reflect these themes. A top-down portfolio decision often consists of several individual strategies. One should not take an individual strategy out of the portfolio context and analyze it individually. Further, time periods for review of portfolio decisions warrant careful attention. Calpers is a long-horizon investor, so decision-making efficacy should be viewed over a similar horizon, especially when reviewed with the benefit of hindsight. The difference of opinion related to tail risk strategies raised in the media in the past 2 weeks focused on just one part of the portfolio strategy, which is the explicit options-based tail risk hedging strategy, and analyzed it only for the period of the recent market turbulence and assumed perfect market foresight capability. One article calculated that Calpers forfeited an estimate of $1 billion in profit by exiting these strategies. Just to be clear, explicit options-based tail risk hedging strategies are valid investment strategies and can be useful for some investors and during certain time periods. However, different types of investors usually have different utility functions and risk appetites and operate under different organizational constraints. Some of the most reputable and highly regarded researchers have studied this topic. For example, Robert Litterman's paper published in the Financial Analyst Journal in 2011 titled, "Who Should Hedge Tail Risk?" and Antti Jimenez's article, "Do Financial Markets Reward Buying or Selling Insurance and Lottery Tickets?" published in the same journal in 2012. These studies have shown that for large institutional investors with a long investment horizon and low level of the leverage, it is not economical to buy explicit options-based tail risk hedging strategy as a long-term strategy, especially considering the cost of such insurance. We are also humble enough to question our ability to time markets. And without perfect foresight to time the market, we do not believe explicit options-based tail risk hedging is a viable long-term strategy for large institutional investors such as Calpers. The decision to terminate such strategies was not about their validity, rather about their fit in our portfolio today. And if we were to review the strategy again today, we would make the same decision. This is clear in that had we known the COVID-19 crisis was coming, we would still have terminated explicit options-based tail risk hedging strategies. Now, let me explain why. So first on cost. The first issue for Calpers is cost. As the risk-free rate and the expected return on our portfolio get lower, it becomes even more important for us to take a closer look at our investment costs. One of the objectives of the active risk review conducted last year was to identify cost-saving opportunities by finding more cost-effective alternatives. It is our experience that explicit options-based tail risk hedging strategies have an expected cost of 3 to 5% of the protected notional amount, which is about half of the expected return from the underlying asset being hedged. We are trying to hedge the drawdown risk from global equity portfolio mainly, and as you recall that the expected return for the global equity as an asset class is only about 6 to 7%. At least explicit options-based tail risk hedging will cost us about 3 or 5%, so more than half of the expected return. And also, we would have to pay this insurance premium regardless of market conditions. In contrast, in fiscal year 18-19, which was the first year we put our risk mitigation segments in place, and also was a relatively benign market environment with limited opportunities for explicit options-based tail risk hedging strategy to generate returns. And our risk segments realized roughly $2 billion of relative value gain, not loss, or 60 bips at the total fund level gain. Well, during the same time period, our explicit options-based tail risk hedging strategy incurred a cost of 7 bips at the total fund level. Well, we cannot speak to the performance or cost assertions made by others. We can fully reflect on our own experience regarding strategy costs and the relative performance. The second consideration is really the scalability. This is also the question of scale. In addition, given the size of our portfolio, it is not only uneconomical but also ineffective to purchase explicit options-based tail risk hedging strategy. These type of strategies are often executed in the options market, where, due to a lack of depth in the market, it is difficult to gain enough exposure to be meaningful to the size of our portfolio. In addition to the consideration of the cost and the scalability, there's also the fact that there were better and more scalable alternatives available to us. So, as I said, the good news is that we have other alternatives, which are more cost-effective, which we can scale to size. As highlighted, one of the portfolio priorities that our board approved is to mitigate market drawdown risk. In December 2017, the board approved allocations of 15% to factor-weighted equity and 10% to long treasuries, effective in June 30, 2018. As the June 2019 investment committee, we had an extensive discussion on preparing the fund for the next market drawdown, where we answered a series of questions such as, what is a market drawdown? What are the potential impacts on our portfolio? And more importantly, how are we positioned to mitigate such negative impacts on our portfolio? And at the June IC discussion, as well as on several other occasions, we discussed the implementation of risk segments, such as factor-weighted equity and long treasuries as drawdown mitigation measures. And we are glad to report that during the peak to trough of the recent market turmoil, from February 21st to March 23rd, these risk mitigation segment measures provided a drawdown mitigation benefit of more than $11 billion. So one of the reasons we terminated the explicit options-based tail risk hedging strategy was the availability of better alternatives, namely the risk segments. And this allocation decision has proven to be a better alternative during the recent market rout. Now let's take a step back and ask ourselves the question, what was the original intent to have any insurance against a market drawdown? So when considering market drawdown mitigation measures, it is also important to note why we are adverse to market drawdowns. It could be the case that the plan would not survive an extreme market drawdown that would force us to default on our financial obligations, or the plan may not have the means liquidity, to maintain its desired long-run risk exposures, thus compromising its ability to earn the 7% return in the long run. So to some degree, Calpers experienced each of these scenarios during the 2008 and 2009 global financial crisis. Both concerns were related to our balance sheet liquidity management and a lack of centralized portfolio management framework back then. Now, I would like to give some historical background of these strategies that were terminated. Explicit options-based tail risk hedging strategies were first added to the portfolio in August 2017 as an experiment and implemented as an active risk. As we worked to implement the risk segments, we continued to compare and contrast the explicit options-based tail risk hedging with our risk segment strategies. In 2018, we also enhanced our balance sheet liquidity management framework. 2019. In 2019, we also enhanced our balance sheet liquidity management framework and also adopt a more centralized governance structure. The improved visibility into our balance sheet liquidity over future time horizons, along with a more efficient allocation of balance sheet liquidity from the total fund perspective, eliminated the need for the payoff from explicit options-based tail risk hedging strategy. As part of the broader active risk review in 2019, it became clear that such expensive and unscalable strategies were no longer warranted in our portfolio, especially when better alternatives are available to us. So what are the lessons learned? So in summary, we are focused on 4 parts of our market drawdown mitigation plan or strategy, or some call it tail risk hedging strategy. So the 4 parts are factor-weighted equities, long treasury, an enhanced balance sheet liquidity management framework, and a more centralized governance structure. These 4-part drawdown mitigation strategy was developed with a thoughtful, consistent, and logical process, and the plan is largely working as expected. There are some lessons to be learned from the recent market turmoil, such as the effectiveness of diversification benefits from interest rate duration. But terminating expensive and unscalable explicit options-based tail risk hedging is not one of those lessons. If we were to review this strategy again today, we would make the same decision. This is clear in that had we known the COVID-19 crisis was coming, we would still have terminated explicit options-based tail risk hedging strategy and instead gone outright short on our equity exposure, because that would have been a less expensive and more scalable strategy. And of course, we acknowledge that we do not have the perfect foresight. We are proud of the level of transparencies that public agencies such as Calpers provide, and we welcome public scrutiny. We do believe, however, that when looking at the hundreds of investment decisions, big and small, that we make in a year, that they be reviewed through a portfolio context and using a long-term lens. We also constantly remind ourselves to be humble enough to acknowledge that we do not have perfect foresight, and that we should not succumb to behavior biases such as resulting bias or hindsight bias. We cannot accurately predict the future, so we should always plan for different future scenarios. Having a preparation plan in place is similar to having a fire exit sign in the room, in that the fire exit sign doesn't tell us when the fire will break out, but it guides us in what to do once we see the smoke. We learned a number of lessons from the 2008 global financial crisis, and since then we have made some important improvements. We spent last year on 3 major initiatives. 1, an active risk review, so we can identify our structural advantages as well as shortcomings, which then allows us to focus more on our core activities. The second improvement we did last year was building a one fund, one team culture, resulting in a more centralized governance structure, so we can allocate resources more efficiently to maximize the benefit to the total fund. And the third initiative of last year is really rolling out a comprehensive balance sheet liquidity management framework. All 3 initiatives are part of a plan to survive a market drawdown, like what we have just experienced. We are greatly benefiting from the thoughtful planning in the past, in that not only can we continue to pay members' benefits and other financial obligations, but we are also able to maintain the appropriate risk exposure to support our ability to generate our assumed rate of return in the long term. In addition, COVID-19 crisis has generated some extreme market dislocations globally, which in turn has created opportunities. As part of our overall plan, last year we put some specific investment strategies in place to capture such investment opportunities. It is encouraging to see that some of these seeds we planted last year are already germinating. As a long horizon organization, just managing through the current crisis is not good enough. We need to continue to plan for the future. As we discussed this morning, COVID-19 crisis may provide an opportunity to accelerate our plan toward a 7% solution. As the market environment continues to evolve rapidly, we will dynamically adjust our approach to resume our focus on achieving a 7% return in the long run in support of our ability to pay members' benefits. We do not know what lies ahead exactly, but our portfolio is prepared to weather the storm, and we are now better positioned to thrive after the storm. With that, I'm more than happy to address any questions you may have. Thank you.
Thank you, Ben. I want to thank you for that, and thank you for the presentation. Sorry about that, guys. Presentation on the tail risk, because we've heard so much about it in the news. And I just wanted to make a quick comment that this is just a really positive story in terms of what our success as Calpers left tail risk really was. And it wouldn't, and like you said in your comments, it's not something, because we do hundreds of investments, we wouldn't normally highlight. And it is under our delegated authority for us to have it highlighted. It's a disappointment when, you know, we're supposed to, as board members and staff, work as a team. There's a misunderstanding. I would hope that, you know, a phone call to you or me or Marcy or whoever would be the place that we would go, rather than just put it out in the ether. Unfortunately, that's what happened. But what amazes me is that once you came in, you positioned the portfolio to really be able to withstand something like this pandemic, even though nobody knew that COVID was even coming. And I just want to commend you all for that, and commend the investment office for that. I also want to also kind of bring a little bit of focus, just the whole CalPERS team working at home, making sure benefits are still being paid. You guys working, making sure that our investments are working. And this is how California works. These are all California workers. And I just want to tell you all how much we appreciate that. And again, I think this story is much more a positive story than it's, and should have been reported as such. But let me make sure. And thank you again, Ben. I'm sorry. Do I have any more questions? Somebody's raising his hand here. Is that Henry? Go ahead, Henry.
Am I on now?
You are on.
Okay, yeah, I was trying to make sure that my mic was live so I could. I echoed some of the comments that you made, Teresa, and I also just, you know, I guess a couple of weeks ago now, that when I first heard about the issue of the loss of the opportunity of $1 billion, and you know, my question radar went up also. What's going on here? And then after further discussing with Ben and investment staff, I said that was just part of the story. That was a decision that was made to look at an alternative way of diversification through a downturn, and come to find out, as Ben has reported now, that it was $11 billion. So we have to be mindful that when pieces of information come out, I hope that the lesson learned here is that we will get the whole story before we reach a conclusion. And so I remember, back when we had our educational workshop back in, I think it was May of last year, the CFA person gave the investment committee in-service training, and one of his parts of his discussion and comments was managing risk through diversification. And he made comments about the risk of paying hefty insurance premiums to protect the fund. But he went on to expand on there were other simpler types of diversification that would provide the portfolio the investment returns without being as expensive. So I do remember that in-service training. And also, I think we have Wilshire on the phone. Is Wilshire, I would like to call and ask them for their, Tom is on the phone, like to see, have his comments on this issue.
Mr.
Mr.
last
Jones,
name
in
is?
order to, I'm sorry, yeah, I was going to say, Jared, can you move Tom Toth, T-O-T-H, from attendee to panelist? Thank you.
Yes. Okay, Tom, you should be able to turn on your camera and your audio.
Can everybody hear me?
Yes.
Great.
This is Wilshire, the board's consultant. Okay, go ahead, Tom.
Tom Tote with Wilshire Associates. I appreciate the opportunity to chat with you all this afternoon. And I specifically, as it relates to this, I think the current market environment really provides kind of a live stress test on organizations and individual risk tolerance. And I think it's important that we reflect on how this market volatility has the potential to impact decision-making behavior. And I think Mr. Meng did a nice job discussing how the decision-making proceeded in this case, and really a reasonable rationale for expanding other risk mitigating strategies at the expense of these explicit tail risk hedges. Now, that being said, I think during challenging market environments like the one we're currently going through, that questions can and should be asked regarding how the portfolio is being managed. And I think communication and transparency can really be bolstered around that, and particularly in these periods of time. We've talked a bit about that earlier, about increasing the level of transparency, making sure that the board and the investment committee and their oversight function is made aware of what's going on. Because one of the key structural advantages that Calpers has is one of being a long-term investor, but that can really only be harvested when stakeholders feel like they have all of the information that they need, and that they're adequately informed. So that's just the one last comment I'll make around this specific situation. Happy to answer any questions from the committee members or other board members.
So I'm not sure I had any questions, Mr. Toth. I appreciate that. I think I had Rob, who has no communication with us, wanted to make a comment. Do you have the ability to make comment, Rob?
I do. Can you hear me?
Yes.
Yes. I don't know. I use the chat bar, but I guess that's not showing up on your end. I want to first of all, thank Ben for such an open and honest explanation. I wish mainly that the media that had reached out and started this story had actually gone to you versus using second and third hand information without going to get factual information from you first. Would have stemmed off a lot of the heartache, heartburn, and concern. But again, I thank you for your honest and open dialogue, and I appreciate it. Thank you for a job well done.
Thank you, Rob.
Okay, so my next question is from Stacy. And then I want to remind everybody, if you're not already, so far I've called on everybody who has their camera on, but if you're going to ask a question, your camera's off, please turn it on. Thank you.
Thank you, Madam Chair. So Ben and the rest of the investment team, first of all, congrats on doing remote within a week. So within the investment industry, people typically don't work from home ever. And that's because of the confidentiality of the investment. So it's highly unusual, and I think this is great. Number two, Ben, you had mentioned something about meaningful risk mitigation and robust liquidity. Could you quantify that a little bit?
Yes. So on the more effective and scalable mitigation strategy are the two risk segment work the board approved in December 2017 and put into effect in June 30. So these two risk segment work provided during the recent market turmoil from February 21st to March 23, provided the diversification benefit of about $11 billion. So that was the two of the four components. of our risk mitigation plan. And the other two components is really the liquidity management framework plus the centralized governance. So as I said that, why do we need insurance? We need the insurance because we need the money when the crisis comes. We need the liquidity. But now, given the new balance sheet liquidity management framework, we have much better visibility into our potential sources as well as uses of a balance sheet liquidity. And more importantly, we build into a lot of on-demand feature into our liquidity management framework. Means that we only pay for the liquidity when we need it, as opposed to explicit insurance policy. You have to pay for the policy, regardless of market condition. So our balance sheet liquidity framework has a built-in on-demand feature. When we don't need it, if we don't need it, we don't pay for it. We only pay for it that during the time of crisis when we need it. So that was very important feature in our liquidity management framework. So the enhanced liquidity management framework is part to make sure we have the liquidity. The last of the four component of our risk mitigation plan is the centralized governance. The centralized governance now allows us more efficient allocation of that balance sheet liquidity to maximize the benefit to the total fund. So once you see the last two components together with a much better management of balance sheet liquidity and much better allocation for the balance sheet liquidity, that eliminates the need to pay for expensive insurance policy that you had to pay for it regardless you need it or not. So that's the how we tie in the four components. The two components, the first two components, one is equity, factor-weighted equity. The second component is the long treasury components. So they provided $11 billion benefit during the most market turmoil. And the last two components gave us the confidence to terminate expensive, unscalable insurance policy because we have achieved the same goal that an insurance policy would do.
You don't like extended warranties?
Well, you're from the insurance industry. You can sell another reinsurance product.
There's another thing I was going to ask you too. So I know we have an economist speaking soon. It'd be great to get a better understanding of kind of COVID adjusted risk performance at our next meeting.
Okay. So COVID adjusted risk performance.
Risk mitigate. So the performance of our risk mitigation measures adjusted for COVID.
Can you specify a little bit what do you mean by adjust for COVID?
Right, so
with or without?
Right. We've looked at our risk mitigation measures in the context of a little bit of a downturn. We have the historical data points from 9/11, 2008. But what we're looking at with COVID is different, and we're looking at potentially the intersection of an economic decline similar to 9/11, right? Because there's a travel ban of sorts, not entire, and then with the 2008 global recession. So if you combine the pandemic and you combine a recession, that intersection, how do our new risk mitigation measures then perform in that context? And I know this is something we anticipated before, but it would be good to have an understanding of what we can expect over the next 18 to 24 months.
Got you. Okay, so we'll come back in June with some of the analysis.
Great, thank you.
Thank you, Stacy. Let me see. I have Betty. Oh, I'm sorry. I had David Miller first. I'm sorry.
Okay, I think I'm off mute now. I just wanted to echo what, wow, I'm getting a huge echo here myself. But just thanks so much to the team, to Ben. It's just been extraordinary that you've been able to stay calm and carry on and work remotely. And it's just quite an amazing accomplishment. I wanted to kind of repeat some thoughts that I've expressed before. I'm really disappointed and sad that you've had to endure some of the disparaging remarks and characterizations I hope that you appreciate that I and a lot of others still have full confidence in the CalPERS team and your leadership on these. And I would hope that if I had a misunderstanding or didn't understand something, that I would come to you or the team to understand before I would assume that experts who I trust were trying to mislead me or cover something up or hide something and make disparaging remarks to the press. And I'm sorry you guys have had to endure that, and I hope that that kind of behavior will not continue in the future.
Thank you, David.
Thank you, David. Also, you sound like you're an announcer at a baseball stadium, just FYI. Betty.
Thank you, Teresa. I can't help but to think that we're going to see more of this armchair quarterbacking going on. And so I'm trying to figure out as I'm listening to all of this, and I really appreciate Ben's explanation and really walking us through the thinking about, just why we, abandoned that strategy. But I'm wondering if there's a way to think about how we heighten transparency around this going forward. And I think it's a little tricky because obviously we don't want to play bare.
Betty, one quick second. Can everybody mute? I think we're getting some feedback. Thank you.
Anyway, it's tricky because this is something that I think all of us leave to the experts. On the other hand, I think we're going to see more of these judgments being cast with respect to the position of the fund, and particularly when it's in these volatile times. And so I guess what I would ask Marcy and Ben and the team is, are there opportunities to really get out ahead of this? Where you've taken some action and perhaps when it's appropriate before anyone casts aspersions or judgment on it, to just be completely upfront about what we've done. And I think one of the ways to do this is to have obviously regular updates with us that as you're taking these actions that could be sensitive, and particularly during these times where we're probably headed into a prolonged downturn, there is a lot of there's a little misunderstanding with respect to these strategies, and it would be good to just think about some way of getting out in front of it a little bit better. We're spending more time trying to manage, frankly, the misinformation than we are about just trying to stabilize the portfolio as a whole. And so I would ask maybe Marcy, Ben, and working with our public affairs team to figure out how we can be a little bit more proactive around just how we tell this story going forward. This will not be the last of armchair quarterbacking.
I agree. Thank you very much, Betty. I think that's, Marcy and Ben, we've talked about that before. I know this was a really small portion of the strategy around, working to make sure that we were shored up for the downturn. But I think if we were in front of it a little better, this wouldn't have happened. Again, I do understand it was such a small part that it wasn't something we were thinking about, but go ahead, Marcy.
Just thank you for your feedback. We completely understand. We are working on an improved process by which we can get some of these decisions that maybe at the time do not seem like large decisions, but large monetary decisions versus large political decisions are two very different things. And I do believe, not just because CalPERS is the largest fund, but there are a lot of people who are really interested in what we're doing and how we're managing the portfolio, in particular through COVID-19. And so, to the extent that we can be more transparent with the board, but as well as just more transparent generally out to the stakeholder community, and then get in front of the stories and, do some proactive outreach to a curated set of reporters who really genuinely want to write the facts about what's going on with us. And I think there are a lot of interesting stories that could be written, and I would like to see us be more in the driver's seat for those. So appreciate the feedback. Thank you.
Great. Thank you very much. Thank you, Ben. I appreciate your candor and your report. We are moving into 7 action consent items. I've been asked to pull 7B, the review of the investment committee delegation. So I'd like to get a motion for approval of the December 2016 investment committee meeting minutes. Do I have a motion? Anybody?
I move.
Okay, moved by Ms. Oliveras,
Second.
second by Mr. Miller. All those in favor? And I'll need a roll call.
Teresa Taylor,
Aye.
Rod Steckner,
Aye.
Henry Jones,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Stacy Oliveris,
Aye.
Okay.
Lisa, I just want to give you a
Jason
quick.
Perez,
The voice in the background, David, is Calpers, but I'm on.
No worries.
I'm on mute.
No, you're not.
Let you know.
Lisa,
I'm just gonna email.
you are not on mute.
Aye.
Jason Perez,
Aye.
Ramon
Rubalcaba, yes.
and Betty Yee.
Aye, thank you.
Welcome to the wonderful world of video conferencing. So I'm going to move. I want to make sure that we have everybody here that we need to have here before we move into 7B. So is Ann Simpson available?
Yeah, thank you, Teresa. Jared, if we can move Kit Crocker, and then also to Ms. Taylor's point, Ann Simpson to panelists from attendees, please, to field questions on this item.
Okay, Ann Simpson, you should be able to show your video. And Catherine Crocker, you should also be able to share your video.
Let's see. There she is. All right, everybody appears to be here. So the 7B is review of the investment committee delegation. It's an action consent item, and I'm going to throw this to Ann to go over this for us really quickly because this is part of our work streams. Go ahead.
Madam Chair, thank you very much, and for the opportunity to remind us of what this work is all about. The board went through a very comprehensive self-evaluation that was facilitated by the National Association of Corporate Directors. And this process raised a number of issues for the board to address in order to improve the board's own performance. That was the goal. Board President Henry Jones formed a number of working groups of board members who would pick up the key issues that came out of the evaluation. One of the issues was an observation that many of the documents that the board refers to for delegation, for policy, were quite lengthy. There was duplication. There was some very arcane language, and there was a lot of legalese, repeating advice and material which is set out in other places for the law. For example, quotations from the California Constitution. So on this delegation of the investment committee, what we've done with help from our legal team and enterprise compliance and review by the investment office compliance team is put forward a new draft which holds on to all of the investment committee's authority and responsibilities. There is no change in the delegated power. We've had some colorful comment in the media about this, but the whole purpose of this new draft is to bring clarity about roles and responsibilities. This draft is not intended to change those roles and responsibilities. It reflects current practice, which is the role of the board delegating authority to the investment committee, and then the investment committee through its investment policy, delegating to the chief executive, who in turn delegates to the chief investment officer. So when you look at the track change version of this document, you'll see that repetition from other legal sources has been removed. And the logic here is that all of this material will be available through the website and through the board's own platform, so that when there needs to be a reference to, say, the California Constitution and what it requires of the board, that's something that's going to be there in the original. It doesn't need to be repeated through each of the separate documents, because then everything gets very long, gets repetitive, it duplicates. And what we're hoping here is to have real clarity about roles and responsibilities and have everything put into plain English. And that also, I think, is a better outcome for stakeholders to understand what the different elements of the Calpers governance structure are, the roles of the board, the committees, the consultants, and management. So that's the purpose of this draft, and we look forward very much to the committee's review and recommendations. Thank you, Madam Chair.
Thank you, Anne. I really appreciate you going over this. So I just want to remind everybody that that's what this was really just to make it less legal, and it hasn't changed anything. But I'd like to throw it to Ms. Crocker to kind of go over it itself, if you'd like, real quick.
Yes, happy to. And first want to echo what Anne said. The role clarity and better, simpler, plainer English is all in support of good governance. And we've eliminated any of the language that was, we suggested removing was either illustrative, detail, or something that's really subsumed in policy. So it is the committee directs staff with respect to its behavior in managing the portfolio through investment policy, and everything should be within policy in terms of the direction from it.
Okay, thank you. I do have a couple of questions. So first, Ms. Yee, Controller Yee, go ahead.
Thank you, Madam Chair. And just a couple of thoughts. So I know that one of the goals of the work stream, different work groups, was to look at how we streamline the, I guess, the oversight responsibilities of the board. And so there were a couple places that kind of gave me pause, but I guess what I want to do before I kind of point out the one section that I have concerns about is just to maybe talk about the practical aspects of what's happened since we started the work stream process. And that is concurrently with looking at, I guess, changes like this to the delegation and other potential changes in policy. We also, with respect to the investment committee, reduced the number of meetings. And we also don't have a full board membership on the investment committee. And so I think given that, it gives me pause with respect to then how do we, the one deletion that I find problematic is the deletion of the oversight of the asset class strategic plans, as well as the risk management and control environment. I just think we don't have enough time to cover this, given that we've reduced the number of meetings, but this seems to me very, very core to the oversight function of the investment committee. The staff, we typically have the presentations of the asset class annual reviews in the fall. And so I'm just concerned about the fact that we are, I guess, compromising a little bit of our oversight authority. And then also, I think we need to have the asset class strategic plans to really understand the total fund perspective. And so, in my mind, and this is the way kind of my head works, is that it's kind of building blocks, if you will. So I don't know how we really can say that we're retaining robust oversight responsibility with the deletion of that particular section. So I would just ask for some comment there. as well as just how we kind of accommodate all this, because I don't think really streamlining meant that we were going to be moving to this extreme of where we don't necessarily understand the construction of the overall portfolio by giving up oversight of the asset class strategic plans.
Actually, if I might respond to that, that is a very valid concern. The committee does retain full authority over the strategic plan activity via the investment policy, which requires staff to develop and deliver the strategic plans annually by program area, and also specifies that the board consultants will also present and comment on the strategic plans. So I think it's really more an intent here of sort of equal dignity. You had a level of generality in the rest of the delegation, and then to get really specific in some areas could imply that you need that level of specificity elsewhere. So that I think was really one of the guiding principles just from a drafting perspective, but absolutely not intending to suggest that the committee doesn't have oversight of those important activities, because absolutely you do, and you absolutely control that via investment policy.
And can you address it too? Thank you.
Yeah, thank you. Thank you very much. Yes, I want to emphasize that the purpose of this is to make sure that the draft is clear and it does not change or seek to change any of the delegations or authorities that the board retains in its plenary role and responsibility overseeing everything, including things that are delegated. So as Kit says, when you look at the investment policy, which the committee oversees, which is 97 pages, it goes into a tremendous amount of detail on risk management, on asset classes, total fund performance and more, benchmarks and so forth. So I think the thinking here was that we don't want to repeat little bits of what's in the policy in the delegation. However, this is the board's document, and if in the drafting we've lost something that we are viewing as being implicit or referenced in the policy, then it should be restored. I think we, look forward to the committee's recommendations to us. But there is no intention to change delegated authorities. That is not what this project was all about. And Controller Yee and Henry Jones, this was your work stream. And really the purpose of this was clarity on roles and responsibilities and putting things into plain English and avoiding duplication. That's really a simple task. So,
Anne, could you also address the oversee investment office risk assessment and control environment? Controller Yee mentioned that as well.
Yes, thank you. Thank you very much. And thank you for the question, Controller Yee. Again, in the overall risk responsibility of the investment committee, this again is implied. It's a part of what you need to be have as an integral part of overseeing risk management. And as Kit said, rather than elaborating all the different elements which are set out in the policy, we summed this up as the risk responsibility that you have. But however, this is particularly in a time like this, the idea that there would be some abandoning of due diligence, rigor, care on the risk front could not be further from our minds. So we very much look, we're here to make this draft simple and clear and efficient to help with the board's governance project. So as I said, we very much welcome suggestions on how to improve the draft. So thank you.
Madam Chair, if I could maybe just elaborate by example.
Sure.
And I appreciate that we're still guided by the overall policy, so that hasn't changed. But I think what the delegation suggests is that now we're actually getting down to roles and responsibilities. And I guess what I'm concerned about are two things. One, as I look at this delegation and some of the language that's been stricken or proposed to be deleted, if you're just looking at the delegation, and particularly as it relates to, as we're all each, on this committee thinking about, what is our oversight responsibility going forward, it does leave some question in my mind. So I'll on page 204, attachment 2, where you have, let's see, it was under the second resolve B, subparagraph 5, approve and oversee asset class strategic plans and portfolio construction guidelines. I mean, and that may be implied in the policy, but that seems like a big deal to be deleting in the delegation, at least in my mind. So, and I think we've seen some public response to that as well. So without kind of referring back to the policies, I think it's hard for, all of our stakeholders really understand, what is our role here. And then the second question, and I really do think this is going to be the reality of what's going to happen. We're going to get the annual review scheduled in the fall. We're going to run out of time and we're not going to spend that time. And that just to me is like we're not doing our diligence if that's the case. And so this came also on the heels of where we had changes in committee membership, numbers of committees, being reduced. And so I think there's a cumulative effect in terms of, are we really compromising with respect to transparency and our oversight responsibility? So I think I'll leave it at that, but that was just an example I wanted to highlight.
Okay, so Anne, did you want to answer to any of that before I go on to the next person?
Yes. This is the committee's document, and our job is to make sure that it is clear and it's simple. I want to reiterate, this came out of the board's own governance evaluation, and the intention is to have clarity and avoid duplication. But if there's something that has been lost in the public perception, or even in where the committee feels what's set out in this, then that needs to be dealt with. So I guess the question, once this is through, Madam Chair, is for you to give us your feedback on how you'd like the next draft to look, or if you'd like us to come back with a new draft, having heard these comments. And thank you for all the questions that are being raised, because these are very important issues, and certainly exactly what good governance is all about.
So, Ms. Yee, if you could kind of outline what it is you're looking for that we can give to staff, and then I'm going to, because everybody's got questions, so I'm going to get other people to, like, if there's stuff that you don't want taken out, or if you have language you'd prefer.
Well, yeah, that was one example I offered. I mean, I can go through the document again. And I mean, here's my concerns. Anyone who looks at this exercise who may not have been a part of it would think that we are essentially reducing our oversight responsibility with some of the deletions. True, not true, whatever, but that's the appearance of what we're dealing with. And I still think the other thing that we did not reconcile was that there were parallel work streams with respect to committee membership. And, as you recall, all of us recall, the investment committee used to be a committee of the whole. It's no longer. There were several members who expressed a desire not to be on investment committee, and that's fine. But just because they expressed a desire not to be on the investment committee doesn't mean it diminishes our oversight role. I mean, it was that wasn't the intent.
And I don't, yeah, I get
it. Maybe because they had competing interest. I mean, this is a time-intensive committee. I get that. But at the same time, those of us who are serving, I think, have a job to do. And I think when it comes down to this delegation, which is really now about roles and responsibilities, it just has to be made more clear. And maybe, and the way to do this would be to look at whatever you're deleting is to make a reference back to the policy that we haven't necessarily lost ground here, because that's what it appears to be here. And I just want to be just very, very clear about the fact that this committee, I mean, I will already say, I think we're going to be challenged in terms of the times that we're in, the issues that we have to stay on top of, the number of meetings that we've been reduced to having, the kind of less than full membership on the committee, I mean, we're going to be challenged. And so I would think that we would err on the side of, not making these changes for the time being until we get a sense of how operationally these really are going to be, what kind of effect they're going to have operationally.
Okay, so I'm hearing a vote for just leaving it the way it was from Ms. Yee. I'm going to move on to Jason, and then we can all discuss this. So Jason, go ahead.
Thank you. Betty brought up a lot of what I was going to say. I was trying to look it up because my notes did not transfer over. I was reading somewhere where it said that we have to adopt as opposed to approve on a lot of this stuff. And I can't find where I had that, so I apologize. Kit, can you comment? Did I imagine that? Keep in mind, I've been working a lot.
Yeah, we did change a verb in a spot or two. Let's see, I think conduct strategic asset allocation became approve strategic asset allocation.
I'm fine with that.
And I should let Anne speak. I think these really were Anne's governance suggestions. I thought they were good and on the clarity point, but
right.
The idea here was that it is staff that conducts the ALM and then the IC approves it and the board approves. So I think that was that little tweak, what that was intended. Anne, you should speak to that though.
Yes, thank you, Kit, and thank you, Mr. Perez, for noticing that particular point. This was about being clear. So I'm sure the investment committee would be horrified if you actually had to conduct the asset allocation. Obviously, that's teamwork in practical terms between the investment office and the actuarial office. The governing role of the committee is oversight and approval. So that was in order to clarify roles and responsibilities. I do also want to say that if in this process other questions are being raised, that this is not useful at this point, there is absolutely nothing that requires the investment committee to change anything in the existing delegation. The existing this was intended to be a tidying up exercise to get rid of legalese and duplication. But if it's raising concerns, that's absolutely not what this project is about. This project is about plain English, clarity, clear communication, and making sure the right things are in the right place. So things that are in policy are in policy, delegation is delegation. The California Constitution stays as the California Constitution. But if it's right to leave this be for now, we completely understand that. Our job here is to be helpful.
I'll tell you what, and to suspend the rest of my questions, I know.
I apologize.
No. Teresa said that we potentially going to go to a vote, so I'll suspend the rest of my comments or questions until after that, because they may not be necessary.
Jason, I'm not sure. I have a whole bunch of people that want to ask questions, so finish your questions.
Okay, so on attachment 2, page 404, where it says resolved, it's stricken out resolved E, that, and I know Kit spoke to this a little bit, but it says this resolution is effective immediately upon adoption and supersedes all previous delegations of authority to this or any predecessor committee. That's pretty powerful. So now this is
Whoa.
Basically.
Okay, yeah. So is that your last question there, Jason?
Well, that's the question, and my statement is, look, I want to empower you guys to do the strong work that you absolutely do. You're the professionals. I am not. There's only a couple of investment professionals on the board. But like Anne alluded to a second ago, at the end of the day, it's my work that you absolutely do. You're the professionals. I am not. There's only a couple of investment professionals on the board. But like Anne alluded to a second ago, at the end of the day, it's my rear that's on the line. All of our 13 of us. So I'd like to see some more robust reporting in the discussion that I had with Dan privately and with Marcy as well. And I'll stop there.
All right, thank you, Mr. Perez. So I'm just going to give you guys who I've got in order. Lisa is next, then Stacy, Henry, and Margaret. So that's who I have so far. Okay, and so let's start with Lisa.
All right. Thank you, Madam Chair. And I'm not going to repeat everything that Controller Yee said, but I agree with it completely. I'm going to add to number 5 that she raised, questions with regard to number 7, where we are eliminating the words including ensuring that the fund has sufficient liquid assets to respond to market conditions and meet investment obligations, e.g. capital calls, collateral calls. I'm struggling to understand how that's not plain and directive English that that anyone could follow. I do appreciate Ms. Crocker's point that by being specific in some areas and general in others, it raises questions. But I think in the times that we are in today, we raise far more questions by eliminating the kind of language that was in number 5 and in number 7. Thank you.
Thank you.
Last question that I would have. It is my understanding whatever we approve as a committee, this has to go back to the full board for approval.
Correct? Yes, correct.
That's correct.
All right, thank you.
Okay, next is Stacy.
Thank you, Madam Chair. I echo those comments of Controller Yee as well. And based on what you were saying earlier, I don't think this is the right time. We've had a lot of headline risk, and we're going to have a lot more over the next 24 months. So making changes to board authority during an economic crisis is probably not the best time. I would also add, well, staff has said that authority wasn't removed. I would say that there's a temporal difference here, right? So if you're involved with conducting something, or if you're involved in the review and selection versus the approval, there's a major time difference. So on an annual basis, you might get a performance report, but there's a lag there, right? The performance happens much earlier, and it's going to take a lot more time for that change to actually go into effect versus being involved in the selection process. So I would support holding off on making these changes right now.
Yeah, thank you. I would just like to emphasize that this document does not propose to change the board's authority. The board's authority comes from the California Constitution. The committee's authority comes from the board. This is intended to make it clear in the delegation what the key responsibilities are, and to be read in conjunction with the investment policy, the 97 pages, which goes into all the detail. But I absolutely accept your comment made on the timing issue, but it's very important for the record because this has been said in the media and it's not accurate. This is not intended to change delegation authority, not intended to change the plenary authority of the board. And indeed, that cannot be done through this process. This would require the California Constitution to be amended. The purpose of this is to improve governance by bringing plain language and clarity between different governing documents. But I absolutely respect the point you're making about timing, but I don't want the record to suggest that this is intending to change authority, because it's not.
Right, and I think there's been some misunderstandings regarding this, especially when it comes to deleting the word conduct and changing that with approved. And so I think I understand it's important to have guidelines that are very easy to understand, but again, I think this might wait for another time.
So, and I will, thank you, Ms. Oliveris. I will say that I'm hearing duplicate requests, one on number 5 and one on number 7, which is to keep those in.
Right.
I haven't heard from everybody else yet. I still have Margaret to go, and now I have David to go.
You missed me.
Did I miss you, Henry?
Yeah, you said I was next.
Oh,
And
gosh
me
darn
too,
it.
Teresa, I don't know if you saw my name.
Oh, my gosh. You guys are all moving up. That's why. Okay.
Okay.
So,
I'm on.
yeah. So real
Okay.
quick, I just want to, so far what I've got 2 options. I'm just putting this out so everybody knows. Stacy's option, which is not to change. It sounds like Betty, her option is to make sure that we keep option 5 in the strikeout to put it back in, and option 7 to not strike out all that language that we struck out in option 7. So I just want to make that clear for everybody. Henry, you are next.
Thank you, Madam Chair. Yeah, I echo many of the comments that are made, and I know the purpose of this was to good governance and clarity, and somehow it may not have totally accomplished that goal. And so I would suggest, since I am one of the board members assigned to this along with Betty, I would suggest we do what we did with the code of conduct, is that take it back and we've heard from the members of their concerns, and kind of do like the code of conduct what Jason did, is to see side by side what the issues are and raise the number of them. And then Betty and I could then, being the members responsible for working with Ann, to come back to this committee with another document.
Right.
That's what I would suggest.
Thank you.
Oops. I think that's a great idea. I want to get everybody's questions in before we take a vote on that. So next was, after Henry, was Margaret, and then Ramon, and then David. Go ahead, Margaret.
Thank you, Madam Chair. My issues are similar to that of Ms. Oliveris and Ms. Yee, also Ms. Middleton. And that is, I really think it does appear that we are giving away the board's authority. It's always our responsibility, but we can in fact give away our authority. With respect to number 3, conduct versus approve, the concern is that if we switch it to approve, we may only get one option. I was not on the board in 2017 when you did that asset allocation, but you basically got 4 options because you were conducting it. That's my recollection of that process. And I want to make sure that if you change number 3 to approve, that staff might just bring you 1 to approve as opposed to all the variables, and that's a concern. I certainly don't agree with removing 5, so I think 5 needs to stay in there. I also want to talk about number 10, especially for some of the newer board members, which is to oversee the selection process and performance of investment partners. I wasn't on the board at the time, but I remember there was an opportunity for the staff to give all the private equity to one manager, and it came out in a newspaper story. The board didn't even know about it, and there was a big brouhaha. Then there went for an RFP, and it turns out their price was too expensive. But if you remove number 10, we don't get the option of selecting or looking at the process the managers use to bring us these investment partners and managers. And this could be with respect to private equity, real estate, or anything else. And I don't think we should ever give up number 10. And then of course not 13, oversee the investment office risk assessment and control environment. I think all these are critical, and we need to hang on to them. Thank you.
Okay, thank you, Ms. Brown, and I am on Mr. Rublikava, please.
Thank you, Madam Chair. I had a couple of comments and then a question. First, I think it's enlightening that we are responsive to press and the stakeholders' comments. There's been some press that somehow adopting this would somehow be a violation of our fiduciary duty, but I don't think that can be delegated. And I had two other comments. One is there is a consultant memo associated with this action, and in it, Wilshire mentioned some comment about that there's still reporting mechanisms in place, and there will be the we still have the governing tools, so to speak. So I just want to put that in perspective. But on the other hand, I understand how what is intent can be looked at differently from different points of view. And so my question is more procedural. If this is not adopted, because I understand there's always an annual delegation, at some point there's two questions. One, do we still need to make an annual delegation, or is it just roll over? And second, if there's no change, or if there's we don't adopt this, I notice there's language that talks about the annual appointment by the president, the board president, of an investment committee to be comprised of no fewer than 9 members of the board. So will we go back to the old way, or does that action are we revisiting that action too if we don't adopt this document? That's my question. Thank you.
Anne, you want to answer that?
Well, that was my understanding is as follows. This is a draft for this committee to review. If the draft hasn't got to the right place yet, then we should do some more work on it. There is a full board decision about forming an investment committee. And again, I do want to recall the argument at the time from a different working group on the board about this. And the argument here was that it would strengthen governance because all board members still have their plenary full authority as board members, but that by creating an investment committee, there was an opportunity for a deep dive, just as there are deep dives with all the other important topics that the board has to have oversight, approve policy, approve decisions on critical issues. And, the discussion at the time, I remember, was something as important as investment needs more than one pass through. So you measure twice, you cut once. So by creating an investment committee, it's not that people are being kept out. This is creating a new body to do extra work, and the full board still retains the decision-making authority. So that's a little bit more of an answer than you asked for, but my understanding is that the
Go ahead, Matt.
by the full board. Oh, Matt, thank you.
Yes, to circling back to Mr. Rubalcava's question, which is a good one, it would not change the decision that was already made with respect to the rejiggering of the reconstitution of the investment committee. That was a decision that was made. It was affirmed by the full board. That part of this redrafting or revising of the delegation is really ministerial and was put in there to reflect a decision that was already made. So that decision would not change, but we would want to bring forward, if nothing else was amended, we would simply want to bring back an amended delegation that reflects that decision that the board already made.
Okay.
Thank you.
And
Okay.
if I may, Madam Chair, I think that may already be reflected in the current delegation. And I say that because it's not redlined here. And I had asked that question, and I believe that's the answer I got, that had already been reflected. And the board, and to answer Mr. Rubalcava's question, excellent question. The board governance policy is what is the reason we're here, actually. It requires that the committee's delegation be reviewed annually and updated as needed. So if the answer is we don't need to update it, I think we're good.
Okay.
We can confirm that, but I think we'd be good.
Okay. So last question is with Mr. Miller.
Thank you. You know, it strikes me that I still very much support the idea behind doing this, to make things in plain English, to clarify things, to not be redundant of the basically what are decisions the board has already made or that have been set into law for the board about what our responsibilities, what is required of us. But I think that right now, to Ms. Oliveira's point and Controller Yee's point about the timing, how this will be viewed by stakeholders and others, I think that the degree of disinformation that has kind of gotten out there where people didn't understand it, I think we've got to do a better job of communicating to folks, especially those who really don't understand that a lot of this would be reiteration of other documents that we, you know, so I think really this is not the time to do it. We take a look at it again, bring it back after we've had a chance to correct the disinformation, communicate with stakeholders, allow board members to think about how they would like to see it. But I think that right now, with the degree of disinformation and the degree to which people are inclined to think the worst of our motives and intents on things has been played upon, this is probably not the time to do that because it reinforces some of those negative impressions, fair or not. That's kind of what's happened with this. And so I think we're probably better off not trying to do this, certainly not today.
Okay. Thank you, Mr. Miller. I agree. I agree with you. I think we're about ready to take a vote, and I think that I kind of see where. Oh, Henry, did I miss you again?
Yes, you did. Do we need a vote? I mean, because this is one of the coming out of the work streams, and on all the other work streams, when there were concerns or that the committee members had, we just directed it to go back for review. And I think that you've heard 4 or 5 of us say that it needs some work. So
if we can direct the committee to take it back for review, and for it also sounds like I'm hearing other people say they just don't want it changed at all. But in any event, I do have public comment on this. But at this point, do I have most committee members agreeing to send it back to the originating committee for review? Yes. Thumbs up. Okay. Okay. So that's where we're going to go. I'm going to move. Thank you very much, Ann and Kit. I appreciate it. I'm going to move to public comment on this. And I don't know how that's going to work.
Yeah, so this is Marcy. We need to bring Kelly Fox in. And what Kelly will do is he has received the emails that have come in for public comment, and he will read those up to 3 minutes into the record.
I don't see him on here. Okay, go ahead.
Okay, so what I'm going to do is give the subject and then read the content of the email and then who it is from. So we have this one from Warren Grimsley, April 20th, 2020 meeting notice of the Calpers Board of Administration. In the content, I firmly oppose the reduction of board investment oversight as a rejection of its fiduciary duty. End email. The next one from Adam Riley, subject public comment on 420 meeting of Calpers Investment Committee Board. Hello, I am a California voter and I firmly oppose the reduction of board investment oversight as a rejection of its fiduciary duty. Passing a change in oversight does not change the legal fiduciary requirements, and board members are subject to being held legally, personally responsible should anything go wrong. It would be a grave mistake for board members to approve this. End email. From Daryl Cleveland. Subject, public comment for Calpers Board. I firmly oppose the reduction of board investment oversight as a rejection of its fiduciary duty. We, the members and beneficiaries, have our hard-earned pensions, demand that our elected board members represent us and the future of our pension plan in a manner of integrity and prudent fiduciary responsibility. It is imperative and incumbent upon you as board members to do so at all times. Your role as board members is no different than any other elected member in a representative governance, and you only derive your role and authority from we, the governed. Therefore, we, the governed, demand your absolute commitment and diligence on our behalf to maintain our pension system as a solvent entity of public service to those who have served the public. If you cannot commit to this demand, then it is incumbent upon you to responsibly resign your board position and clear the path for more committed and clear-minded persons to see this important and critical task. End email. From Martha Donahoe. Public comment for 2020 Investment Committee. To the Calpers Board, I am a retiree from Santa Clara County, currently receiving a Calpers pension. I would like to publicly comment about the proposed changes to the Investment Committee delegation resolution. Very unfortunately, the Calpers staff has had a history of criminal behavior, Messrs. Bonrestro and Villalobos, that should have impressed the board with the importance of intensive oversight of Calpers staff. Any reduction in oversight should be avoided, even if it means you have to work harder as a board due to these difficult times. The complexity of staff investment recommendations should be a reason to dig deeper, not step back as a committee and a board. You should have complete access to information and prompt answers to your questions. The staff works for you, and you are fiduciaries for us, the beneficiaries. Engage in more, not less, oversight of staff. Make sure staff can explain and justify what they are doing and planning and who they are doing it with. These are obligations you undertook when you joined the board, and it is especially important given the past history of fraud and the current economic crisis, which is still unfolding. Therefore, in regard to agenda item 7B, I urge you to reject these proposed changes that are on a consent calendar for 2020. And then it names number 5, number 10, and number 13. End email. From Anthony Butka. Public comment on April 20 Investment Committee, Agenda Item 7B, Investment Committee Delegation. Honorable Board, as a retired beneficiary of Calpers, I believe this proposed delegation of the Board's constitutional fiduciary duty to we the beneficiaries is wrong-headed, inappropriate, and quite possibly illegal under California law. It would result in there being little functional oversight by the Board of their mandated oversight duties under the California Constitution, Article 16, Section 17A. Which states, A, the retirement board of a public pension or retirement system shall have the sole and exclusive fiduciary responsibility over the assets of the public pension or retirement system. The retirement board shall also have sole and exclusive responsibility to administer the system in a manner that will assure prompt delivery of benefits and related services to the participants and their beneficiaries. The assets of a public pension or retirement system are trust funds and shall be held for the exclusive purposes of providing benefits to participants in the pension or retirement system and their beneficiaries and defraying reasonable expenses of administering the system. Recent decisions made by CIO Ben Meng have clearly had disastrous financial results for the plan, and yet there is no indication of any affirmative oversight being taken by the Calpers Board. Rather, this consent request for further delegation. I believe that to simply throw away the limited oversight which the board currently exercises is the height of folly. I further believe that in the event the board adopts consent item 7's proposed delegation of authority, the board will open itself up to a potential class action lawsuit on behalf of all Calpers beneficiaries on the grounds that the board has violated their fiduciary responsibility as required by law. End email. Ellen Brown, subject, board oversight. What is going on with Calpers investments when a loss of $1 billion can be shrugged off? There must be more oversight by knowledgeable, in quotes, board members. The responsibility falls directly upon the board members' shoulders. My husband is a retired correctional officer with a background in finance. he would be a more responsible board member than the current members. End email. From Kathleen Astor, Calpers Board Oversight. I firmly oppose the proposed reductions in board oversight for Calpers. The organization is poorly run and I pay high premiums for my long-term care insurance. I want better management and more oversight. Please reject the changes and begin to look at the managers. Some need to be terminated. Thank you. End email. From Sarv Grover. Subject, responsibility of the board. Forward. I, Sarv M. Grover, is a CalPERS member and am asking the board not to abdicate its responsibility of overseeing the fund's management. I appreciate your consideration. Thanks. End email. From David Soares. Subject, public comment, April 20, 2020, Investment Committee, item 7B, opposition. My name is David Soares. I'm a CalPERS beneficiary retiring at the end of 2016 after 32 years as a prosecutor in Silicon Valley. I represented over 300 prosecutors and public defenders in collective bargaining for 12 elected terms on the board of the Santa Clara County Government Attorneys Association. And I currently serve as an assistant area director of the California Retired Public Employees Association. I write in strong opposition to proposed delegation IC 2001, which would delegate this board's historic and mandated oversight to the unqualified and unaccountable staff. The PERF has recently struggled to reach even 70% funded status. Staff needs more oversight, not less. Article 16, Section 17 of the California Constitution declares that the Board of Administration is the sole fiduciary of the fund and states that, quote, a retirement board's duty to its participants and their beneficiaries shall take precedence over any other duty, end quote. As a fiduciary, each member of this board owes a duty of care to the members and beneficiaries which cannot be lawfully delegated to staff. This duty of care encompasses the bolded duty of inquiry, that a fiduciary make reasonable inquiry, entertain a good faith belief in the prudence of a course of action, and have no personal interest in the outcome. If any member of this board feels that discharging their constitutional duty as a fiduciary is such an inconvenience that they must unlawfully delegate that obligation to staff, I respectfully request that they submit their resignation forthwith. I caution the board that you are each personally responsible for the discharge of your obligation to act as a fiduciary, and it would constitute a theft of public funds to expend trust money, opposing the members and beneficiaries should they seek to compel you to perform your duty. In the email.
Hey, Kelly, your volume's dropping. We can barely hear you.
All right, I will do better. From Al Darby, subject, Investment Committee, public comment. Mr. Chair and Investment Committee members, good afternoon. Al Darby, President, Retired Public Employees Association. RPEA finds item 7B misplaced in the Investment Committee agenda as a consent item. These proposed changes to the delegation should be fully aired as action agenda items. We believe the surrendering of board member fiduciary duty contained in the proposed new Investment Committee delegation to be a continuation of serious erosion in board oversight and its responsibility for investment office function and policy. Staff usurpation of more and more board oversight duty threatens the security and soundness of the PERF and permits proliferation of non-transparency and uninformed board decisions. Several clauses in item 7B raise serious questions around board participation in formulating policies that provisions in item 7B interfere with. In clause 5, board member involvement in asset class strategic plans and portfolio construction guidelines is limited to simply approving and not conducting deliberations. This deprives the full board of complete information about specific details when debating approval of, for example, ALM options. The deletion of clause 10 is an egregious change that deprives the board of its responsibility to select investment and PE managers, which is already somewhat abrogated, and non-board consultants. This creates an opening for favoritism and substandard performance. Clause 13 clearly denies the board its ability to exercise its fiduciary duty by eliminating its risk assessment and control environment oversight. All of this adds up to abdication of even more board responsibility and fiduciary duty if these changes are allowed to stand. RPEA urges rejection of this consent item and recommends that the entire policy be reconsidered. Thank you. End email. From Stephanie Hugh. Subject, Investment Committee Item 7B, Changes in Delegation of Authority. Stephanie Hugh, a Calpers beneficiary. I oppose the proposed changes to the delegation of authority drafted by staff, wherein the board is sliding its responsibility to oversee staff and the investments of the pension and retirement fund. I watched the March meetings. I heard that the left tail hedge was performing as expected. I did not hear that it had already been abandoned last year. I read reports in various media about the staff eliminating billions of dollars in left tail hedge protection mere weeks before the market crashed, at an approximate loss of $1 billion. It appeared the board was not informed, nor did they authorize this. This is why staff needs more oversight, not less. The board and this committee have an obligation as fiduciaries to oversee the fund, the staff, conducting the asset liability management study, and the overall risk for the fund. I request that you do not slough off your oversight of the staff and your responsibilities to beneficiaries. It is your fiduciary duty to ensure our pension fund and investments survive. Thank you for your time. End email. From Michael McCaskill. Subject, public comment, April 20, 8:45 a.m. For the Investment Committee Agenda, 8:45 a.m., April 20, 2020. Dear Calpers Board, my name is Michael McCaskill. I am a Californian and board member of a member agency and a JPA, former chair of both. I am very concerned about the abdication of your fiduciary responsibility by reducing board oversight of our investment. When specifically asked by a board member about left tail investments, your CIO replied about any left tail risk hedging strategy you're referring to, without mentioning that most of what was thought to be being referred to had been liquidated. There's a small amount of sociopathic wiggle room in this response, since he qualified it as regarding any hedges being referred to, which could imply being ones Calpers currently held, and happen to exclude the big recently dropped one. This is a very glaring material omission. I fear what other surprises may be in store. In the context of a staff member reporting to fiduciaries, I see no other interpretation than his response being a blatant lie. The fact that your general counsel and CEO witnessed that and have done nothing to protect Calpers or you as board members from liability shows your problems run deep. I strongly urge you to replace top management. You may be personally liable for Calpers losses, as your D&O insurance will not cover gross abdication of fiduciary responsibility. I repeat, your staff are lying to you in public, on the record, and your CEO and general counsel seem okay with that. You have a fiduciary responsibility. You must replace top management and increase your oversight of our investments. Thank you, Michael McCaskill. End email. From Jim Rasconi. Subject, Investment Committee Meeting, April 20, 2020. I am a Calpers active member, and I adamantly oppose this agenda item as written. You must not reduce the board's investment oversight. This is literally an abdication of the board's fiduciary duty. The board has already relinquished far too much authority and latitude to staff. Staff needs to be held accountable by the board. Strong board oversight needs to be maintained now more than ever, especially now in light of the recent market actions and the incompetent decision regarding the exiting of tail risk hedge fund by CIO Ben Meng. In parentheses, who knows what other dire consequences will rear their ugly head as a result of other not so transparent decisions made by the CIO and staff, in parentheses. The board must maintain their fiduciary duty to active members, retirees, and taxpayers who fund this institution. More oversight is needed, not less. End email. From Roxanne Woodward. Subject, agenda item 7B, changes to delegation of authority. Hello, my name is Roxanne Woodward. I am a retired Calpers beneficiary. I gave nearly 40 years to public service of this state. I deserve the right to protect my retirement funds. I deserve transparency. I deserve my pension. I earned it and not you. I oppose the board proposed changes to the delegation of authority drafted by staff, wherein the Calpers board is abandoning its responsibility to oversee staff and the investments of the PERF. I've read the media reports about staff eliminating billions of dollars in hedge protection just weeks before the market fell. I fully understand that this action ever disclosed by staff to the board. I think it should say never. Simply speaking, staff needs more oversight, not less. More importantly, when the CIO was asked about our investments at a public meeting, staff failed to advise the board that the hedge protection had been eliminated and that we would not be receiving billions of dollars in our hedge protection. As fiduciaries, the board has an obligation to its beneficiaries to consider the overall risk to the PERF, oversee staff, and conduct an asset liability management study. As a CalPERS beneficiary, I ask that you do not abandon your oversight of the staff and your responsibilities to each of us beneficiaries. We've worked hard for, earned, promised, and need our pension to survive. End email. From David Yaguchi. Subject, delegation resolution number IC 20-01. Please read the following message to the Investment Committee on April 20, 2020. To the Board of Administration, CalPERS. It has come to my attention that the Board of CalPERS is attempting to transfer all decision-making authority regarding investment decisions to its staff in violation of both its own rules and Constitution of the State of California. So what the board is attempting to do is not only to brazenly avoid responsibility for their actions, they want to not have any actions for which to be responsible by not doing any work. This is not only lazy, it is unconstitutional. May I remind the board of its own governance policy. Number one, the California Constitution provides that the board shall have plenary authority and fiduciary responsibility for the investment of monies and administration of the system. It is charged with the sole and exclusive fiduciary responsibility over the assets of the system and is granted the sole and exclusive responsibility for administering the system in a manner that will assure prompt delivery of benefits and related services to system members and beneficiaries. Sole and exclusive, in quotes, means just that. I think it is outrageous that elected board members would seek to abdicate their constitutional duties and responsibilities to staff, leaving no one accountable to the people and to the employees whose money and future is invested in this large pension fund. A board without decision-making responsibilities is a rudderless ship. I strongly urge you not to approve this resolution. Best regards, end email. The next email was submitted. They are identical by two people, so I'll list both their names and read it once. From Robert Gerling and from Sherry Keith. Dear members of CalPERS Board of Administration, on behalf of CSU IRFSA, we would like to register our extreme concern with regard to the management of our investments. IRFSA firmly opposes the reduction of board investment oversight as a rejection of its fiduciary duty. Bloomberg, the Wall Street Journal, and Institutional Investor have published new reports in the last week on the escalating controversy surrounding CalPERS CIO Ben Meng missing out on over $1 billion in gains by exiting a tail risk hedge right before the recent crash. The issue here isn't simply that Mr. Meng made poor investment calls. Every investor makes mistakes. The issue is that Mr. Meng appears to have exceeded his authority by firing the tail risk managers without informing the board or even CalPERS consultant Wilshire Associates. CalPERS is afflicted with the worst crisis since the Great Depression, and based on a series of articles in the Wall Street Journal and other financial publications, it appears that the chief investment officer is not up to his job. In the last 2 weeks, 2 of CalPERS' best and brightest employees have quit to go back to the private sector. Ron Lagnato, who essentially followed Meng's career path as the fund's fixed income quant and then became the deputy head of asset allocation, and in parentheses, and is a Caltech PhD, in parentheses, has just left to work for an options specialty firm. Paul Muchaka, who ran real assets and did much to turn the real estate portfolio around and divest bad assets, is going back to his native Canada to be a senior partner at one of the biggest Canadian real estate firms. Furthermore, CSU URFSA strongly requests that Margaret Brown, State Treasurer Fiona Ma, and Board Member Irena Ortega be reinstated as members of the Investment Committee. We need all of the best minds on board actively reviewing our investments. And finally, according to state law, the retirement board of a public pension or retirement system shall have the sole and exclusive fiduciary responsibility over the assets of the public pension or retirement system. To reiterate, URFSA firmly opposes the reduction of board investment oversight as a rejection of its fiduciary duty. We are committed to ensure that prudent oversight and competent management be restored to Calpers. Sincerely. End email. From Margot Sarah, or Sarah Margot, I can't tell here. Subject, public comment reject the delegation resolution. Dear Calpers Board, this public comment is for the April 20 meeting, open session, item 7B, review of the investment committee delegation. I strongly urge you to not delegate any oversight duties to the staff. Chief Investment Officer Ben Mang just made a series of grave mistakes lying to the Calpers Board about left-tail investments, ignoring Wilshire when he exited a hedge just before it would have made the fund a great deal of money in the way of the coronavirus economic crash, exaggerating the cost of the Universa program, and misrepresented that the positions he chose made $11 billion when in fact they lost $30 billion in 2019. The Calpers Board needs to exert more rigorous oversight, not less, and if you choose to delegate more oversight to unqualified people like CIO Meng, your fiduciary duty means that you are liable to lawsuit and could go bankrupt when the staff continues to behave like CIO Meng has been behaving recently. End email. From Tim Behrens, subject, Investment Committee. I'm giving public testimony on agenda item 7B. Good morning, committee chair and committee members. My name is Tim Behrens, president of the California State Retirees. I am speaking against the strikeout language in agenda item 7B, attachment 2, delegation of authority. I believe the Calpers Board has the fiduciary responsibility for oversight of Calpers investments. This oversight is each board member's responsibility and is a duty you were elected or appointed to do. Please vote this agenda item down and continue to protect the stakeholders' pensions. Thank you. End email. From Steve Kashur, subject, more board oversight, not less. I have read the financial press with growing alarm about recent failures by CalPERS to protect adequately the retirees and taxpayers of California. This shows that the current direction, reducing board meetings and reducing oversight, is wrong. I call upon the board to wake up and take its constitutional required fiduciary duty much more seriously. We need much more oversight, not less. End email. From Ray Snodgrass, subject, Investment Committee meeting 4/20/2020, consent item 7B. I am Ray Snodgrass. I represent the active and retired firefighters of CAL FIRE Local 2881. We do not support the changes proposed in consent item 7B. The proposed language goes too far in relinquishing board oversight of staff relative to investments of our retirement fund, in parentheses, PERF. During this unprecedented period of fiscal uncertainty, oversight and protection of the PERF is most important to all members of CalPERS. Now is not the time to make such policy changes. Thank you. End email. From Joseph Papa, subject, board investment oversight. Good morning. My name is Joseph Papa, and I am a retired dependent on the PERS pension program. I have just read the Naked Capitalism article stating that the PERS board is considering reducing its already paltry efforts to perform its responsibility to guide the PERS staff towards safe and sane investment strategies. If you cannot be bothered to do what is required to provide this guidance, then I suggest that you remove yourself from the board in the interest of its members and beneficiaries. Lest you have forgotten it, I have reproduced your responsibility per Article 16, Section 17A, subsection A of the California Constitution. The retirement board of a public pension or retirement system shall have the sole and exclusive fiduciary responsibility over the assets of the public pension or retirement system. I firmly oppose the reduction of board investment oversight as it is a rejection of its fiduciary duty as outlined in the California Constitution. End email. From J.J. Jelensik, subject Public Comment Investment Committee 7B. I am J.J. Jelensik, a beneficiary speaking to my trustees. You are managing my, in capital letters, money and have a fiduciary responsibility to me. This is a time when you need to pay more attention to my assets, not less. The actions staff takes as your agents are your actions. It is not responsible to say that you will monitor your agents and my assets even less than you already do. The responsibility and liability remains with you. Remember that as a fiduciary, you are held to the highest standard. I also point out that the liability waiver agreement you entered into with Calpers is a probable Government Code 1090 violation and will offer little protection. Please reject the proposal. Thank you. End email. On the next 11 emails, they were all identical. So I'm going to read the names of the submitters, and each one of those emails is exactly the same. From Marlon Brandel Sr., Pat Fuller, Michael Warren, Kathy Martin, Rita Perez, Laura Hopt, Eddie Roberts, Daniel Heredia, Robert Treviso, Antoinette Renwick, Carrie Matsumoto. I oppose the proposed changes to the delegation of authority drafted by staff, wherein the board is abandoning its responsibility to oversee staff and the investments of the PERF. All you have to do is read reports in the media about the staff eliminating billions of dollars in the left tail hedge protection mere weeks before the market crashed, and that never told the board to understand that staff needs more oversight, not less. More importantly, when the CIO was asked about our investments at a public meeting, staff failed to advise the board that the left tail strategy had been eliminated and we would not be receiving billions of dollars in our hedge protection. The board has an obligation as fiduciaries to oversee staff, conduct the asset liability management study, and the overall risk for the fund. I beg you, please do not abandon your oversight of the staff and your responsibilities to beneficiaries. We need our pension to survive. Lastly, this email is exactly the same, although there are additions to it. It begins by saying, "Dear friends and colleagues, can you send me an email today to protect your CalPERS pension? Please share with your colleagues who should also be concerned about their CalPERS pension. The meeting starts tomorrow at 9 a.m. Your comments should be in by 9. Thank you for helping me protect our pensions. Send your email to board@calpers.ca.gov, and it is signed at the bottom by Margaret Brown, member, CalPERS Board of Administration." That concludes public comment for item 7B. Madam Chair, back to you.
Thank you. Thank you very much. I'm trying to see, I know we have a break coming up. We have that. It was kind of, I'm tempted to ask if Ben would respond to some of these. I'm getting all kinds of messages from people. If Ben would respond to the last part that we're hearing.
Yes, Madam Chair. I don't know which one won't let me respond.
Oh, I'm so sorry. Hold on.
Yeah.
Go ahead, Ben.
Yeah, so a moment ago, we addressed the committee in length about our decision to terminate the explicit options-based tail risk hedging strategy. We terminated that because of the cost and scalability, and also because we have other better alternatives. And as we reported again, that our better alternatives turned out to be a better alternative, proven over the recent crisis. We gained more than $11 billion of benefit from the drawdown mitigation. In terms of the disclosure of whether the board didn't know or not, there are two major considerations. One is the maturity. As we mentioned, that the termination decision was made really as part of the broad active risk review, the strategy review of last year. And in total, we redeployed capital of $60 billion. And this strategy only represents only 0.25% of the capital total capital redeployed. On the total fund level, is not even 4 basis points. So in terms of materiality, does not rise to the level to report to the board. And for two, the termination of the strategy was continued until the end of last month. And I just know that these kind of securities tend to be illiquid in the market. So we need to protect the financial interests of the system before the trade were fully executed, given the size and the illiquid nature of the position. So that is on the in terms of transparency with the board. And then there's a few comments mentioned about the question last March from one of the board members. So I went back to the record. So the question to me was that, Dan, can you tell me how our left tail investment are performing? Are they performing the way they thought they would in this economic downturn? So since I returned to Calpers as CIO on January 2nd, 2019, I have been discussing with the committee on our tail risk hedging strategy in the context of a portfolio of 4 components: sector-weighted equity segment, long treasury segment, enhanced balance sheet liquidity management, and then centralized governance structure. And this 4-part strategy is working largely as expected. That's my answer to that particular board member's question, that from what we know, most of these strategies are performing as anticipated. The reason I said most of these strategies, not all, because one of the 4 components, the long treasuries, is not working exactly as anticipated when it comes to providing tail risk hedging benefits. Without specific mentioning of the explicit options-based strategy, no names of specific managers in the question, I interpret the question as a general question and referring to what I have been discussing with the committee since I became the CIO for Calpers, which is our 4-part drawdown risk mitigation strategy. I answered the question truthfully and honestly based on my interpretation of the question. And as I said in my reply, most of these strategies are performing as expected, and that's still the case. It was only in the past week and only via media and social media posting did it become clear to me that the board member had a follow-up question on the details around the options-based strategy, which we have canceled for the reason I explained earlier. The cost is too high, the impact is too low, and for the fact that we had better alternatives, which proven to be better alternatives, that's the decision was the best decision for Calpers. So that's my answer to you, Madam Chair.
Ben, thank you very much. And I just want to say, I said earlier that the board and staff works as a team, and after hearing commentary calling into question our CIO's honesty, et cetera, I want to make it very clear that a board member has a right, after they ask a general question in open session, especially if it can be interpreted if you go too much into the granular, that it's something we can't talk about in open session, which is investment strategy, that they can go directly to the person they asked the question for. We're board members. It's not like we're members of the public. So it's really important that the board members work as a team as well. So I think after Ms. Brown made sure that she coerced and helped other people get by this last letter that was read into the record, having other people put letters in with misinformation, and I'm so sorry that they were given misinformation, because she had every opportunity to talk to Ben, to talk to Marcy, to talk to Rob, who's chair of the investment committee at the time, to talk to Henry, the president of the board. She did none of those things, and I think it's incumbent upon us to call on bad behavior when we see it. That is all I'm going to say. My next commenter is Mr. Perez.
Thank you. So I telephoned our consultants on this exit of the TEL strategy, and hindsight being what it was, I asked them to ignore what we know now, and they said that it was a prudent move, especially given the complexity of what we going through in regards to protecting our funds. I do have concerns that I voiced to the appropriate people, and I was assured that there are steps in place to help the notification of that type of decisions. But all in all, I still stand behind Ben and the investment office to do the work that they need to do. And we need to do whatever we can to minimize this noise, to allow them to get the work done as opposed to work on a PR nightmare. That is all.
So next is Mr. Miller.
Thank you, Madam Chair. I think this again kind of reiterates to me that it's really incumbent on us to communicate with the stakeholders to help them understand when there's things that they are liable to misunderstand or be actively misinformed about, and we can anticipate it, that as board members, it's incumbent on us to help them understand. For example, that changes are not an abdication of responsibility, that do not change anything about our responsibilities and are not us failing to be effective fiduciaries, or and that these things don't indicate that we're not doing our job or that staff are not doing their job or are criminals. And so it's our job to help communicate that to stakeholders, not to fan the flames of these things. And I feel very sorry that our staff have been subjected to this kind of disparaging characterizations. And I've seen it happen too many times now. And I really hope that as a board and as individuals, we can help step up and support the Calpers team, the Calpers leadership at setting the record straight. And I would hope in future that our stakeholders, some of whom have been former board members and know very well what is in our delegations and how they relate to what's in the Constitution and the law and our board and governance structure, to not continue this kind of behavior, and we can hopefully go forward and not have these kind of damaging to our system, damaging to our interests and the interests of our members and our retirees and their dependents, because that's a failure of fiduciary responsibility. Thank you.
Thank you, Mr. Miller. I am seeing that Rob wanted to talk. Is that true, Rob?
It is.
All right. Yes, you are.
Thank you, Madam Chair. Well, first I want to join in with Mr. Perez and Mr. Miller in their comments. Very well stated. I do also want to thank all of the folks that took the time to write in. Unfortunately, I wish you'd been given more accurate information. I think Mr. Meng did a good job earlier today explaining the situation. And again, this afternoon, I think he did a good job explaining why he did what he did and explaining the conversation that took place at the board meeting. I do want to state for the record that I heard a number of times in those emails about the March board meeting. We didn't have a board meeting in March, folks. So I want to make sure that we have that correct on the record. That conversation took place in February. So again, there was even more time for anyone to reach out to Mr. Meng and ask for clarifying information. Beyond that, I just can't sit back and watch staff continue to be berated, especially, I believe it was Mr. Soros that said unqualified staff. Unqualified? Sir, who gave you the ability to say who was qualified and unqualified? These people work hard every day. This is the same staff that has come to work every day during this entire coronavirus outbreak. 20% of them coming to the building every day, making sure that your retirement checks are paid every month on time, that your health care is taken care of, that you're always put in the right place, they're protecting you. And I do want to point out that these are all public employees, and you all represent retired public employees. I'm not sure how many of our 2,500 people are going to be willing to join your organization the way you're treating them. Thank you.
All right, my next commenter is Henry. Thank you.
Thank you, Madam Chair. Yeah, I echo all of the comments that my colleagues have said, and I just want to let Ben and the investment staff and the whole organization know that the board is 100% behind you, and we do not subscribe to derogatory types of comments that have been made about your ability to carry out your responsibility. I think that if you look back, people forget about the uncontrollable, or what I refer to as black swan events, that causes some of these discussions to be raised to the level of everybody's concern. But I think we need to also be prepared to applaud our staff when they take the necessary steps to mitigate the impact of those events, as Ben Meng has done. And Mr. Meng, some of you might not know, but I remember when Mr. Meng was here before, because I think Mr. Fechter and myself were the only two members on the board at that time. But this factor-based strategy, Mr. Meng was talking about, we need to pursue something like that years ago. And so he probably, when he returned, he was able to now implement it, and it turned out to be good for the system. And I also would like to mention that these writers from various blogs and newspapers, I would just hope that you get all the facts before you start to write one part or one side of the story. I do know that there was one news media that had an opportunity before they released their story. They did call Mr. Meng, and they didn't have a more balanced story, because they was able to hear from Mr. Meng of what steps he had taken. So I would just hope all of those who are sending out information to others that they do the same thing. And to my retiree members, I go out every time you ask me to come speak to you. I know our CEO goes out and talk with you, to your groups. I know our chief CIO goes out and talk to you. So when you have these concerns, call on us and let us come and explain to you, or have Mr. Meng or his staff come and explain to you before taking up one side of the of the problem and then reprinting that and going out to just literally hundreds of people. So then, therefore, it's a broader misinterpretation of what has really happened. So I just hope that you, because some of the changes that have occurred about stakeholder involvement came from you guys, and you want us to come out and talk to you. But what good is it if we come out and share this information with you, and then when some pieces of information come to you, you don't come back and have it clarified through the proper process. So we'd appreciate if you could do that going forward.
Okay, and I have Lisa Middleton is our last commenter before we go on break and take up a vote on 7B. First, I'm sorry, we're going to take a vote first and then go on break. So Lisa, go ahead.
Madam Chair, well, I thought we weren't going to take a vote. We were going to send it back for.
I'm being told we have to vote. I'm sorry. I checked twice here. I'm being told we have to vote on it because we pulled it from delegated authority. I'm sorry, we pulled it from action consent. So we have to vote to send it back to the staff.
Chair Taylor, I don't believe that to be the case. This is Matt Jacobs speaking.
Okay.
I think that you can, you have to send it on back and bring it forward the next time. And having done some checking, by the way, on Mr. Rubalcava's question, the document as it stands now does in fact effectuate the decision by the board last fall about changing the makeup of the board. It's just, it's a little bit confusing when you look at it because it's got some verbiage changes with respect to those particular provisions, but as it stands, the delegation does in fact effectuate that decision.
So we do have to vote on that part of it.
No, I'm saying that part already exists.
That does already exist. Okay, I misunderstood you. All right, thank you. I'm sorry, I was being told by someone else that I had to take a vote. So then my last commenter is Lisa Middleton. We do not have to take a vote, but we do have to take a break. So go ahead, Lisa.
Thank you, Madam Chair, and I will keep it short. I second all of the comments that were made by my colleagues. These are very difficult times. It is incredibly easy to scare people. It is very difficult to bring facts back to the situation once people have become frightened. We need, as one of our obligations, to ensure that all of us who are dedicated to defined benefit pensions are working together, board and staff, to make sure that we're doing everything that we can to move through this crisis together. We are being stressed and we are being tested, and we're going to find out whether or not we have the ability to work together to weather the financial storm and ensure that the things that people have worked for all of their lives are actually delivered to them. There is a sacred obligation that each and every one of us takes on when we have the responsibility that we have here, and we take it seriously. And it is incumbent on us to make sure that we are performing in such a way that we give confidence to this system. Thank you.
Thank you, Ms. Middleton. I'm going to call for a break right now, and we will take up the rest of the items after the break, and it's a 15 minutes, 5, 10, 15. So 20 after 5, about 22 after 5. So everybody be back at 22 after 5.